In this episode, we're talking about the steps you need to know in order to buy a house. All right. Well, welcome. This is a really exciting episode. We're episode 8 here. Today we're going to be talking about all the things you need to know about buying properties. And I'm really happy to have our senior lending specialist, Monique Love, here with us today to help us out with that. So welcome, Monique.
Thanks for having me.
Yeah, no, our pleasure. So let's just jump right into it. So let's start with the steps. Like, what do people need to do? What's the first thing they need to do when they're buying a house?
Well, that's a really good question. For first-time home buyers, you really want to first sit down and look at your budget. That's the most important thing that you need to do before you buy a house.
Right.
A lot of times we don't realize all the expenses that go into buying a house. So, that's the most crucial step. So have a sit down, go over your budget, figure out what can I afford.
Right on.
And when you're looking at that budget, make sure you're including unforeseen expenses on the house, such as repairs, house insurance, all those additional expenses that you may not have right now when you're paying rent.
Right. Okay.
Once you've found that magic number or, a comfortable range, then you want to go in and see your banker. At that point, they're going to pre-qualify you for a mortgage pre-approval. So they will actually crunch the numbers and figure out, now, what will the bank allow you to have for a mortgage?
So that when they do the pre-approval, they're going to give you a number that you can go out and now start shopping for a house, and then you can know how much you're going to spend on a house, or have a rough idea of that?
Correct, yeah.
Okay.
So, and the reason you want to do the budget first is because often the bank will qualify you perhaps for more than what you're comfortable spending.
Yeah, good point.
So you want to ensure that when you meet with your banker, you know exactly what you're comfortable with spending on that house.
Okay, right on. So once you've got the pre-approval, and I think that's a really good point because banks have been lending lots of money over the last number of years.
Yes.
So knowing what you can spend is really key. So once you've got that number, though, the next thing is you're going to put down an offer on a house, after searching for one through a realtor or whatever. What happens? Let's take it to the next step where they've accepted your offer. You're about to purchase a house. What do you need to do after that?
So once your offer is accepted, there's two different scenarios. You may put in an offer with a condition to financing.
Okay.
Or you may put in an unconditional offer. You'll see right now with some of the bidding wars that there are a lot of unconditional offers that are being placed right now.
Right.
And the difference between the two is obviously with a condition to financing, your banker has X amount of days to secure that financing on that particular house.
Right, okay.
So once you've bought the house, your realtor will send me the offer to purchase and the MLS listing. At that point, what we're going to do is convert your pre-approval to a final approval.
Right, okay.
And the reason that step is important is because a pre-approval is essentially qualifying you based on your credit merit and your ability to repay the mortgage. The final approval will take into account the details of the house.
Okay.
So how much did you buy it for? How much are you putting as a down payment? And all those other details that the bank is going to want to know before they approve your mortgage on that particular house.
Right. Okay. Now, do they look at also like the value of the house itself? Will they send out their like an appraisal, or will they have that done just to make sure the bank's not lending out more money than what the house is worth? Or
yes. So once we get a approval on the house, then it will likely be conditional to an appraisal.
Okay.
So they will send out an appraiser to give a fair market value of the house. And how they're going to get that is obviously comparing recent sales in the market,
Mm-hmm.
in addition to how much you paid for it and all the finishings and everything in the home. The bank wants to ensure that you didn't overpay or severely underpay for the house.
Right. Okay. Okay. So once that's done, is it out of your hands at that point? Like things are going to like the lawyers, or how does that all work after that?
Yeah, so once the final approval is in place, what I like to do is sit down with my clients and discuss, especially for first-time home buyers, I want to discuss mortgage terms, rates, amortization. So what does it look like after they're in the house? So we're going to sit down and we're going to break it all down.
Okay.
Now, when we're talking about people who've bought their homes for the first time, this is going to be an in-depth conversation about fixed term or variable term, amortization, and of course, importantly, rates as well.
Right. Okay. Okay. Are you making recommendations one way or the other at this point, or?
You know, it really depends on the client, but ultimately the goal of that meeting is to decide exactly what term and product that we're going to go into. We're in a interesting market right now where mortgage rates are increasing. As most of us know, prime rate has just increased a 1/4%.
Right.
So all of the variable terms have consequently also increased a 1/4%.
Right.
So what we're doing is providing advice around what is the best fit for you.
Right.
So I'll be asking clients questions like, what is your goal with this house specifically?
Mm-hmm.
Are you comfortable with a payment that may vary over time?
And that comes back to the budget as well, right? Like, you know, how much
Exactly.
flexibility do you have in that budget?
Exactly.
Could you withstand a 1% increase in your mortgage rate? Like,
Yeah.
what does that look like, right? So,
Yeah.
yeah.
So we're really trying to prep our clients for that, 1 or 2% increase in mortgage rates.
Right.
We want to ensure that they're in a comfortable position, not just now, but at renewal time.
Yeah.
So, whether that's the simplicity of a fixed term over X amount of years, so they know exactly what their payment is over the next 3 or 4 or 5 years, or whether it's taking the advantage of the lower rate on the variables right now,
Right.
and paying as much as they can on their mortgage, or do they want the best of both worlds? Do they want the flexibility of having a lower payment on a variable mortgage, blended with the, let's say, security of having a fixed payment on the mortgage?
Yeah, right. No, I think it's so interesting right now, especially with rates rising, as you suggested. I mean, I recently wrote a piece on this where we're talking about the difference between rates today and the average rates, and in that piece I calculated that if rates even get close to the average, some people are going to be, or a lot of people are going to be looking at $1,200 a month increases in their mortgage payments. So it's pretty significant, the difference, and so just get back to your comment on knowing your budget is really important. I think stats show historically people who go into variable rates probably pay less over time.
Yes.
You'd agree with that? Yeah.
Yeah.
But that doesn't mean it's the right decision, right?
Correct. And also, I encourage people not to choose based on the rate solely. The 5-year term, 5-year fixed term is a buzzword in the market.
Sure.
So people will come in saying, what's your best 5-year fixed rate? And at that point, we just need to take a step back and say, okay, is this the right fit for you?
Right.
Because we know the majority of 5-year fixed terms don't last the full 5 years.
Right. People sell their homes, or they move somewhere else, or
life,
life happens,
children,
right?
You don't like your neighbors, you get married, you get divorced, all of these things. So, we need to look at the goal of the client on repayment and their comfort level with fluctuations, and just like you would do on the investing side as well.
Right, really knowing what's important to them, what
Yes.
their lifestyle is about.
Yeah.
One thing actually interesting came up that you and I were both dealing with together on a client was the topic of penalties, and this is getting back to matching the term to the lifestyle of the client and what we think they're going to do. So can you speak just really briefly about the penalties associated with those terms and how that works and what people might be looking at and why it's so important to match terms?
Yeah, so when we're dealing with the indemnities on the mortgage, obviously there's a few different things. You have a fixed term, which is going to have an indemnity based on the rate and the length of time remaining in the term. Also, for the variable, you're going to have an indemnity based on 3 months interest penalty.
Right.
Or you could have an open term, which in that case would have no indemnity on payout.
Right.
Now this is, these are specific to our bank, but most of the banks are very similar in how they're creating.
The long and short of it is if you break a term early, unless it's an open mortgage, odds are you're going to be paying some sort of penalty.
You're going to be paying for it. Essentially, what it boils down to is how much is the bank losing by you drawing out your mortgage early.
Right.
It's almost always equivalent to what you would pay in interest should the term have gone to the end of expiry.
Right. Okay. So once you've had that conversation, you've matched the client to the right mortgage that suits their lifestyle. Next step from there is you send the information over to the client's lawyer?
Correct, yeah.
Okay.
So once we've decided term, payment, amortization, all of the documents will go to the lawyer.
Right.
The lawyer will typically, once they receive the mortgage documents, they will, say 2 weeks prior to closing date is an average time when they would receive it, usually 10 business days before. They will look at how much are you borrowing and then send a letter to you as a client saying how much do you need to bring in as down payment and closing costs.
Okay, right on. Which is roughly, the down payment depends on the house, but closing costs typically around 2% of the home value?
Yeah,
okay.
Yeah, that's a good gauge. I typically will tell clients to have anywhere from $5,000 to $10,000, set aside for those types of costs, depending again on the size of the house. But
okay, right on. Sign the paperwork with the lawyers?
Sign the paperwork at the lawyers. You'll typically go in only a few days before closing, 2 or 3 days,
right.
Unless there's a reason why you
might
need
be out of town.
if you're out of town or the lawyer is out of town. Often in the summertime, there's a little bit more jigging with dates, but usually it's only a few days before closing. You'll sign with your lawyer, and then you'll go in on day of possession to pick up your keys to your house.
Perfect. Right on.
That's the long and the short of it.
Right on.
Front to back.
No, well, this is good. The reason we wanted to do this one is we have a number of clients and clients' kids who are buying homes right now, and so we thought it'd be good to send them out some information about this. So, no, I think that's fantastic, Monique. So thanks so much for this.
You're welcome.
Stay tuned for the next episode coming up soon in the next couple of weeks. Please be sure to visit us at cgwfamilywealth.com. Send us any emails to cgwfamilywealth@nbc.ca if you have questions you'd like us to answer. And we'll close it off. So thanks very much again.
Thank you.
Ready, aim, fire.